Hi, I'm James Robinson, and this is my stock thought of the week. So this video is entitled What I Learned Analyzing 1,000 Stocks. So let me give you some background. I try and analyze a couple of stocks every day. It's taken me about 3 years to analyze 1,000 stocks. And I want to set the table on what that really means. As I've talked about in my videos, I look at companies in 30 categories, and I do that by looking at a bunch of charts. And most of the companies that I look at, I can tell very quickly that they're not interesting to me, and I don't have to do further research. So I don't want you to think when I say I've analyzed 1,000 stocks that I have spent as much time on the 1,000th most attractive stock as I have on the single most attractive stock. I spend far more time on stocks before I'll buy them than I do in my initial analysis. So this initial analysis is just my filter that allows me to say, okay, these are companies I'm interested in. Let's do some more homework on those. And these are companies that I'm not. So having said that, I made a goal by by the end of 2020, I wanted to have analyzed 1,000 stocks, and I achieved that goal the 26th of December. And so this video is just going to talk about some of the interesting things that I've learned by going through that process. So you can see here a chart of, or a listing of the 1,000 companies that I looked at. And obviously if you look at that on your phone, you won't be able to see the detail. But if you look at that on a big screen, you'll see that every one of those is a company and a public company. And, when you look at it that way, it just gives a sense for it's a pretty daunting task to have analyzed that many companies. But having said that, I've really been surprised at what I've learned by going through this process. And I've learned all kinds of things. For example, I've learned that when you look at a utility company, you're not going to see very much in sales and general administrative. And typically you're going to see nothing because they don't have to sell anything, right? You have to buy their products. Also, what you're going to find, though, is that these utility companies, generally they're government controlled. And so they just seem to make a little bit of money in profits, but they also are constantly piling on debt to maintain and increase their infrastructure. And they're not allowed to make enough money to pay for that increase through their own earnings, because the amount of earnings they can make are capped. And so in my opinion, you have this industry of utility companies that just pile on the debt and over the long term get more and more unhealthy, especially as governments become more and more restrictive on what they'll allow these companies to make, which is one of the reasons why it would be a very unique situation before you'd ever see me suggest you should buy, before you should ever buy a utility company. And there's little nuances like that you learn as you go through this. You learn that investment companies, the T. Rowe Prices and the SEICs and companies like that, they seem to have some real competitive advantages, at least based on what I value for a business. And, the more businesses you look at, the more you get a sense of. And also the more businesses you look at, then you come up with a business that, boy, I really like this business. And then you start learning more about it. And it's fascinating. The other thing that I've really learned, that I've really been amazed at, is how absolutely atrocious so many of these companies really are. I mean, companies that are household names, that stock performs very, very well. When you look at it dispassionately and you take all of the emotion out of it and all of the reputation out of it, and you just say, okay, how does this company stack up? How good a job do they do, in the three things that I care about: how well they manage operations, how well financed they are, and how well they do returning money to the shareholders. So many of these companies they're just horrible. And you got to recognize I'm looking to buy a few stocks. And so I am able to, because I've looked at 1,000 companies, I'm able to quickly rule out a whole bunch of companies because they just don't measure up. But I think that a lot of people are buying stocks based on reputation, based on what they hear, based on what they see on CNBC, and they're really not diving deep into these companies, because I think if they did, many of these companies would be much, much cheaper than they are. One more thing that I should say about these companies is how I arrived at selecting the 1,000 companies that I looked at. What I did and what I have done is I took the Russell 2000, I took the S&P 500, which is the large cap, the S&P 400 mid cap, and the S&P 600 small cap, and I combined them all up. We got rid of any duplicates, and I think I have 2,500 companies or something in that list to look at. And so those are the companies that I continue to look at. I'm halfway through the universe of companies that are sort of in my what I would call interesting companies that I want to get to. So I've got a lot of work left to do, which is great. I'm not going to ever run out of other things to look at. Another thing that you should know is that it's taken me 3 years to do this. So stocks that I looked at 3 years ago, before I would invest in those stocks, I go back and I redo them. So I say I've looked at 1,000 companies. The truth is that I've probably looked at 1,100 or something because I've gone back and looked at a number of companies a couple of times. Also, what I basically did is I started with the Z's and worked my way back through A. And I did that basically because I figured everybody starts at A and I'll start at Z and maybe I'll find some things other people didn't find. There are a number of companies that I would get interested in for some reason, and so I would look at them sooner. So for example, Tesla, I was interested in and I wasn't yet up to T's, but I just went and did it. So that's sort of how I came up with the companies that I've looked at. And I've got plenty of companies left to look at. I think I've got basically half of the S&P 500, for example, done. Although I have decided to finish doing all of the S&P before I do the rest. And that's simply because I've found that when I do videos on the larger companies, I get a lot more views. And, you know, I'm like anybody else, I want to get as many views as I can. Further interesting facts, I added it up. If you add up the market cap of all 1,000 companies, it comes to 26 trillion, 855 billion, $296,814,146. That was as of Thursday. Obviously, that'll fluctuate every day. But that's interesting. It's a big number. It's 1,000 companies. I guess it probably shouldn't be surprising. The 5 largest companies, though, this is really fascinating. The 5 largest companies I looked at are Apple, Microsoft, Amazon, Google, and Facebook. I think those are probably the 5 largest companies in the S&P 500 by market cap. They have a combined value of 7 trillion. So effectively 1/4 of the entire market cap for the S&P 500 is those 5 companies. And when you look at the 6th company, which is Tesla, you find that it's even more concentrated at the top. So of the 1,000 companies that I looked at, 112 of those companies are no longer actively traded. Most of that is because those companies are out of business, although occasionally it's the result of a bankruptcy or some other event that I frankly haven't researched why these companies went out of business. I just know that I've got a chart of all of the companies, and occasionally a company stops showing up because its ticker is no longer traded. So that's happened 112 times out of the 1,000 companies, and that's over 3 years. So I don't know that that's a lot or a little, but that's the number. The 5 companies with the lowest market cap have a combined value of $21 million. So that puts things in perspective. The 5 largest companies are 7 trillion, and the 5 largest have a combined value of 21 million. The net income of all of these 1,000 companies is $623,590,000,000. Again, that includes companies that are in profit and companies that had a loss. They offset each other. But when you divide, the 26 trillion by the 623 million, you come up with a market cap of 43. So that's, a market cap, a PE of 43. So the average PE for the 1,000 companies that I've looked at is 43 times earnings. That strikes me as very, very high. I think that's a reason why people who care about what the whole market is doing should be concerned that maybe we are in pretty treacherous territory. The reason that I do this research is I want to get a universe of great built companies that I can wait until they become cheap enough and then buy them. So of the 1,000 companies that I've looked at, 189 of those companies what I would consider good investments. By that I mean they're really, really fantastic companies. You could just say 20% of the companies that I look at are that number, but it actually is 189. On the other extreme, 203 of them were horrible companies. I mean, like just atrocious, and they've got scores below 2. Again, I grade all the companies in 30 categories between 4 being the best and 1 being the worst. And so, a company less than 2.5 or something is really not that good, but a company less than 2 is atrocious. And there were 200 companies like that. That's 200 actively traded companies. What's interesting is of those 203 companies, 40 of them or 20% of them are no longer in business. That means if I say a company is really, really bad, the odds are it's got, pretty good chance its life expectancy is 3 or 4 years or less. I should actually sell the list of my 203 worst companies to people who short sell, because there's probably some real short selling opportunities in there. I'm not a short seller. The interesting thing that I have, the problem that I have, is the average PE of the 189 companies that I really love is 47. And that makes sense. You would think that the companies that are the best companies or that have the best attributes would trade at a premium to the market. What that means for me is I have trouble finding things to buy. I would love to be doing a stock pick of the week, but I'm not able to do that because I can't find companies that I love every week that I think we should buy. And so I just don't do videos. Having said that, 19 of the 182 companies are currently cheap enough that I would buy. Now, just because it's cheap enough that I would buy and I think it's a great company, when I say it's a great company on paper, but you have to go and look at it and spend some time on it and really analyze it. And I've ruled out most of those companies for one reason or another. A great example of that is a company called Prudhoe Bay. If those of you that are dividend hunters have probably seen Prudhoe Bay pop up on your stock screener. Prudhoe Bay is a oil trust. And what happens is as the oil is brought out of Prudhoe Bay, a portion of all the profits go into this trust and it's paid out to dividends to the trust holders. And the dividends are currently 38%. The reason for that is if you do the research that Prudhoe Bay is on the verge of running out of oil. No one knows exactly how much oil is there, but the geologists have determined, however they do that, that the oil is not likely to continue to come in a lot longer. And so you may run out of oil before your dividends reimburse you for your payment. And that's why the price of the company drops, and that's why the dividend does what it does. So just because a company has solid fundamentals and it's cheap doesn't mean that I'm necessarily going to buy it. It just means I'm really, really researching it. So I know that you're going to ask that, and I waited till now to make sure you'd watch the whole video. But the single highest rated company I looked at was a company called SEIC. It's SEI Investment Company. It has a score of 3.79. It also, by the way, has a PE of only 19. It's a company I've done a series of videos on. I strongly recommend you should buy it. It is what I consider one of my permanent holdings. And by that, I mean, I tend to buy stocks when they go up a certain amount, I sell them in favor of something else. But I believe this is such a solid company that I've just bought it and I plan on holding it for the very, very long term. The worst company that I looked at is a company called Victory Shares Protect America. It has a score of 1.28. I would suspect that would be a fantastic stock for you to consider short selling if you're a short seller, although I don't advise people to short sell. I don't like that strategy. The worst company I looked at that had an actual profit was Autodesk, which is symbol ADSK. That company had a PE ratio of 156. So it seems like it might be a little overpriced, especially considering it has fantastically bad fundamentals and very little profit. And the stock is like $300 a share. And I just don't understand why anyone would own it. But it's a software company, right? So that's why people buy it. Oh, it's a software company. So obviously it's got to be worth infinite amount of money. The most average company I looked at is Philip Morris. It's the 500th ranked company of the 1,000 that I looked at. It has a score of 2.48. Although to be fair, there were 19 other companies with a score of 2.48. It's just that Philip Morris was the one that was exactly in the middle. What's interesting is, again, I rate these companies in these 29 categories between 1 and 4. And the average between 1 and 4 is about 2.5. And interestingly enough, when I went through Philip Morris's score is about 2.48. It's the average company. I then took and did an average of all of the companies, and it came up with 2.48, which I think is fascinating. I did not in any way try and do that. I literally, in every category, looked at every company individually, looked at every category individually and said, all right, that's a score of 3. I went to the next score and said, okay, that's a score of 2. And the scores came out where they did. And the average score for the company came out where it did. And I certainly didn't look back on the 1,000 companies and said, I'm rating it too high or low. So it's fascinating that it came out that way. So anyways, those are some of the facts that I learned analyzing 1,000 companies. I thought you might think some of that's interesting. And that's all I got. Thanks for your time.